The stock market is like a giant flea market, but instead of used furniture and vintage clothes, it's where companies go to sell pieces of themselves. We're talking trillions of dollars exchanging hands every single day. Think of it as the ultimate marketplace for growth and innovation. Companies big and small, from tech giants to your favorite coffee shop, can offer up shares of their business to the public. This raises money for them and gives everyday people like you and me a chance to buy in and potentially profit. But it's not just companies that benefit. The stock market plays a vital role in our economy. It provides capital for businesses to expand, create jobs, and develop new products and services. When the stock market is doing well, it's generally a sign of a healthy economy. And when it's not, well, let's just say it can put a damper on things. The stock market may seem intimidating at first, but understanding the basics is easier than you think. We're going to break down the jargon, demystify the process, and empower you to navigate this exciting world with confidence. Imagine you own a bakery, and it's doing really well. Customers love your bread, pastries, and cakes, and word of mouth is spreading fast. You want to expand, open more locations, maybe even launch a new line of gluten-free cupcakes. The demand is there, and you can see the potential for growth. But expansion takes money, more than you have sitting in the bank. You need funds for new equipment, hiring staff, and marketing your new locations. So, what do? You could take out a loan, but loans come with interest and repayment schedules that can be burdensome. You could also look for investors, but giving up a large portion of your business to a single investor might not be appealing. That's where the stock market comes in. It offers a way to raise capital without taking on debt or giving up too much control. You decide to sell shares of your bakery to the public. This process is known as going public or an initial public offering, IPO. Each share represents a tiny slice of ownership in your company. By selling these shares, you can raise the money needed for expansion. These shares are then traded on a stock exchange, kind of like an online auction house for businesses. Investors can buy and sell shares, and the price of the shares can go up or down based on the company's performance and market conditions. Young investor, media, young investor using a laptop to research and buy stocks online. When you buy stock in a company, you're not just buying a piece of paper, you're buying a piece of the company itself. This means you have a vested interest in the company's success. You're becoming a part owner, a shareholder. As a shareholder, you may have voting rights on important company decisions and receive dividends if the company distributes profits. You have a stake in the company's success or failure. Your financial well-being is tied to how well the company performs. If the company does well, its value increases, and so does the value of your shares. This can lead to significant financial gains over time. You could then sell those shares for a profit. Many investors buy stocks with the hope that the companies they invest in will grow and become more valuable. Of course, the opposite is also true. If the company struggles, the value of your shares may decrease. Investing in stocks carries risks, and it's important to do your research and understand the market. Many people seek advice from financial advisors to make informed decisions about buying and selling stocks. Diversifying your investments can also help manage risk. Staying informed about market trends and company performance is crucial. The stock market can be volatile, but with careful planning and strategy, it can be a powerful tool for building wealth. Ultimately, investing in stocks is about making your money work for you, helping you achieve your financial goals and secure your future. Going public, also known as an initial public offering or IPO, is a major milestone for any company. It's a way to raise significant capital to fuel growth, pay off debts, or even just give early investors a chance to cash out. Think of it as a graduation ceremony from a small startup to a player on the big board. Stock market expert, media, financial analyst, explaining the importance of going public on camera. But it's not just about the money. Going public can also boost a company's profile, making it more attractive to customers, partners, and potential employees. It's a sign of legitimacy and transparency, as publicly traded companies are subject to strict regulations and reporting requirements. This can lead to increased trust and credibility in the marketplace. However, going public is not a decision to be taken lightly. It's a complex and demanding process, involving lawyers, accountants, and investment bankers. The company will be under intense scrutiny from investors and regulators alike. They'll need to have a solid business plan, a strong management team, and a compelling story to tell, to attract and retain investor interest. Section 4. The price tag: supply and demand in action. So how is the price of a stock actually determined? This is a question that has intrigued investors, economists, and financial analysts for decades. It all comes down to those age-old market forces: supply and demand. These forces are the backbone of any market economy, and the stock market is no exception. Think of it like a giant auction house, with millions of buyers and sellers constantly placing bids and offers. Each participant in the market has their own valuation of a stock, and they act based on their expectations and information. The price you see quoted for a stock at any given moment is simply the price at which the last transaction took place. This price is a reflection of the most recent agreement between a buyer and a seller. When there are more buyers than sellers for a particular stock, the price tends to go up. This is because the demand for the stock exceeds the supply, creating upward pressure on the price. Investors are bullish, meaning they're optimistic about the company's future prospects and are willing to pay a premium for its shares. This optimism can be driven by positive news, strong earnings reports, or favorable economic conditions. On the other hand, when there are more sellers than buyers, the price tends to go down. This happens because the supply of the stock exceeds the demand, leading to downward pressure on the price. Investors are bearish, meaning they're pessimistic about the company's future and are looking to unload their shares before they lose even more value. This pessimism can be triggered by negative news, poor earnings reports, or unfavorable economic conditions. Of course, it's never quite that simple. The stock market is influenced by a myriad of factors, and the interplay between supply and demand is just one piece of the puzzle. Countless factors can influence supply and demand, from company-specific news and earnings reports to broader economic trends and geopolitical events. For instance, a change in interest rates can affect investor sentiment and alter the demand for stocks. The stock market is a complex, interconnected system, and even seasoned professionals can't predict its movements with 100% accuracy. Analysts use various tools and models to forecast trends, but the market's inherent volatility makes it a challenging endeavor. Historical data can provide some insights, but past performance is not always indicative of future results. Market conditions can change rapidly, and unexpected events can lead to significant price swings. Investors must stay informed and be prepared to adapt their strategies as new information becomes available. Continuous learning and vigilance are key to navigating the ever-changing landscape of the stock market. Whether you're a seasoned investor or just starting out, understanding the dynamics of supply and demand can help you make more informed decisions. By keeping an eye on market trends and staying aware of the factors that influence stock prices, you can better position yourself for success in the world of investing. In the end, the stock market is a reflection of collective human behavior, driven by the hopes, fears, and expectations of millions of participants. It's a dynamic and ever-evolving entity, where supply and demand play a crucial role in shaping the prices we see every day. Section 5, the roller coaster ride. Factors influencing stock prices. The stock market is not for the faint of heart. It's a roller coaster ride of ups and downs, driven by a multitude of factors that can send prices soaring one day and plummeting the next. Understanding these factors, at least in broad strokes, is crucial for any investor looking to navigate this volatile terrain. Let's start with the company itself. Earnings reports, which provide a snapshot of a company's financial health, are major market movers. Positive earnings surprises can send stock prices soaring, while disappointing results can trigger a sell-off. These reports are eagerly anticipated by investors and analysts alike, as they provide critical insights into a company's performance and future prospects.
Other company-specific factors that can impact stock prices include new product launches, management changes, mergers and acquisitions, and even scandals or lawsuits. For instance, a successful new product can boost a company's revenue and stock price, while a high-profile executive departure might cause uncertainty and a drop in stock value. Mergers and acquisitions can create synergies and growth opportunities, but they can also bring integration challenges and regulatory scrutiny. Scandals or lawsuits, on the other hand, can severely damage a company's reputation and financial standing, leading to sharp declines in stock prices.
But it's not just about what's happening within a company's walls. The broader economic landscape plays a huge role as well. Interest rate hikes by the Federal Reserve, for example, can make borrowing more expensive for companies, potentially impacting their profitability. Inflation, unemployment, and consumer confidence are other macroeconomic indicators that can influence stock prices. When inflation rises, the cost of goods and services increases, which can squeeze profit margins. High unemployment can reduce consumer spending, affecting company revenues. Conversely, high consumer confidence can lead to increased spending and higher stock prices.
And let's not forget about the geopolitical arena. Wars, trade disputes, and political instability can all inject a healthy dose of uncertainty into the market, leading to increased volatility. Remember, the stock market hates uncertainty, and even the rumor of trouble can be enough to spook investors. Trade disputes can lead to tariffs and supply chain disruptions, affecting global companies' operations and profitability. Political instability can create unpredictable economic policies, making it difficult for businesses to plan for the future. Wars and conflicts can disrupt markets and economies, leading to sharp declines in stock prices. In summary, a myriad of factors, both internal and external, influence stock prices. By understanding these factors, investors can better navigate the complexities of the stock market and make more informed investment decisions.